Hello, it's Brent Doherty here from Forex CT. I'm an account executive. I'd like to thank everyone who's attending this webinar today. We run one each every day throughout the week, so try to see as many as you can because they are very informative. Today we'll be looking at trading resistance and support levels. General advice warning: the following education session is not intended to be treated as personal advice. Forex CT provides general advice only that does not take into account your objectives, financial situation or needs. Trading FX and CFDs involves a substantial degree of risk and should only be undertaken with risk capital. Investors do not own or have rights to underlying assets. So, the advantages of trading strategy and resistance levels is that it's a perfect trading strategy for beginners or for people that are time poor. To set your trades, you don't have to undertake detailed technical analysis. You're merely trading against movement of the market, and so that means that it's simple to utilize, and you don't have to have much market knowledge or trading experience to be able to use it quite successfully. You also don't have to actively monitor your positions continuously because it uses take profits and stop losses. The ability to make profits when the market moves unexpectedly means that it utilizes a hedging strategy, so you can actually cover both bullish and bearish movement in the market as well. So if the market moves against what you're expecting, there's still the opportunity for you to be able to make a profit by having a hedge trade in the other direction. Now, the first thing that you're going to have to do in order to be able to do these trades is you're going to have to have access to the daily technical charts. Now, you should be getting these emailed to you twice a day on weekdays, but an alternative to be able to get them is you can actually get them on the trading platform. If you on the symbols next to the currency pairs or commodity or index, you'll see that symbol there that looks like a chart. And if you have a look on the list view, it's even larger and more pronounced, and you can see it to the left. So if you click that, what will come up is you'll get access to the trading signals. And what these are Trading Central's most recent technical charts. Now, there are two sorts of charts that you'll be able to see here, and to access them you use these lists. Okay, there are the intraday charts, which generally take place over a period of a week. And then there is short-term charts which show movement over a year and tries to predict movement over the next couple of days ahead. This is a much shorter-term chart. And if you have a look here, you can see this is a short-term chart. How you can tell that it's a short-term chart is that the period shown is 1 day, and the movement of the chart is tracked for over the last year. Okay, and what these sort of charts do is they show they do an analysis of where the market is likely to move over the next couple of days. And if you look here on this chart, what you can see that Trading Central believes is that the market will pivot around the 0.7610 level. And you're looking at support at the 0.7295, 0.7150 and 0.7 levels. And you've got resistance at the 0.7750 and 0.7835. And what their analysis says is that they believe that this, in general, is a sell. The market's expected to move up a bit, but ultimately they believe that it's heading towards that second support level. And as you can see here on this chart, that's actually tested that support level twice before. So that's a fairly well-established support level. So in this case, it's likely that their analysis is going to be correct. But the chart also says that the market is going to move around the pivot point at 0.7610, and it might climb as high as the second resistance level up here, as it has done before, at 0.7835. Now, now this is an example of an intraday chart. As you can see, the period is much shorter. It's only 30 minutes as opposed to a day. And the period that the chart tracks only goes back for the last 5 days or so. And this chart shows much shorter term movement. And in this case, they believe that the market is going to pivot around the 0.7375 mark over the next day or so. And ultimately, they believe that it's heading towards that second resistance level at 0.7440. And if you go back to that first short-term chart, you can see there that initial movement that they believe will happen before ultimately the market will move down towards that second support level as it becomes bearish. And what this chart here shows is that movement on a smaller scale. Now, when you're using this strategy, you always want to use the intraday charts if possible. The reason for that is that these show movement that's much more tight. Which means that for beginner traders, who don't have much experience or don't have much equity to start with, that they're not risking as much because the movement isn't as long term. So the movement from the pivot isn't going to be as far as it will over a longer time period or scale. And the basic strategy of this is that you're going to set up two dormant trades in the system. You're going to put both a buy in expectation that the market will go as Trading Central has analysed, but you're also going to do a hedge trade as a sell. So that way, if the market moves unexpectedly into a bearish sentiment, there's still the opportunity to make money as it moves down towards that support level if it doesn't move in the expected direction. And the way that you're going to set these trades up is that the first trade you're going to do is going to be a buy. And you're going to set this trade up, and the entry point for the trade is going to be above the pivot point. Now, for those of you without much experience, there are two basic sorts of orders that you can place into the system. You can place a market order, and the market order will execute and start trading immediately at whatever the currency pair or commodity or indice is trading at. So, for example, if I was to open a buy market order on this order and it was currently trading at 0.7389, then the market order would execute immediately and start trading. And for every pip that it went above that, you'd obviously be making money because it's a buy. And then if it dropped down, then you'd be losing. Now, the other sort of order you can make, which you're going to use in this strategy, is known as an entry-level order. And what an entry-level order does is it will sit dormant in the system and it won't execute until certain conditions are met. And in this case, we're going to set it for when the market reaches 15 pips above the pivot point. So the entry order in this case is going to be at 73.90, 15 points above the pivot. So that order won't execute until it hits that pivot and moving up, and then the order will execute and start trading. Then we're going to set a take profit. Now, what the take profit is designed to do is that when the order hits the certain level of that you're hoping it will get, in this case we're aiming towards that second resistance level up here, what the take profit will do will kick in and execute and close the order, giving you which means that you're taking the profits when it reaches the order level that you set. So for a take profit, we're going to set the take profit level at 5 pips below that second resistance level where Trading Central believes the market is moving towards. So in this case, this second resistance level is 0.744, or to make it easier to calculate, you can extrapolate that out to 0.7440. So we're going to take the take profit at 5 pips below that, which will be 0.7435. Okay, so what that means is that the reward for this trade will be from 73.90 if it executes and starts trading, all the way up to just under that resistance level at 0.7435. Now, the second part of this order is we're going to set a stop loss. In case this order executes and starts trading but doesn't have enough momentum and comes back down, we want to make sure that we're not exposed too much, because if it comes back down here, then we're going to be obviously losing money. So what we're going to do for this first order is we're going to set a stop loss at 15 pips below the pivot point, so at 0.7360. So what that means is that for this order, if it does execute and starts trading if it hits 73.90, is that you're exposed from 73.90 down to 73.60. So you're exposed for a 30 pip band centered on the pivot point. And your reward, if it does execute and start trading, is that your reward will be from 73.90 all the way up to 0.735. So ideally, what you want to do with these trades is you want to have a 3-to-1 risk to reward ratio. So for every dollar that you're risking, you're hoping to make at least 3 if the trade does go your way. So in this case, your risk to reward ratio will be from 73.90 down to 73.60, and the reward will be from 73.90 all the way up to 0.7435. Okay, so what you do is you actually, when you're beginning, you'll actually enter those numbers into the system. And if we have a look, When we see that those numbers are entered in, so the order rate, the entry is 15 pips above the pivot point at 73.75. Okay. The stop loss is 15 pips below the pivot point, so it's at 73.60, and then your take profit will be at 0.7435, which was 5 pips below that second resistance level. So if you have a look at the risk-reward ratio, that's you're risking 200 if it does execute and start trading but hits the stop loss, and your reward will be 300 if it does go up all the way up to that take profit. Now, unfortunately, that's not a great risk-to-reward ratio. That's only 3 to 2 in your favor. Ideally, when you crunch these numbers, you should be looking at roughly a 3 to 1 or greater risk-reward ratio to be ideal. And so as you can see there, because the reason for that is that there isn't expected to be much upward movement in this chart. It's just going up to that, they're just expecting it to go up to that second resistance level before it's actually expected on this shorter term chart. As you can see, it's going to come up to there and then they're expecting it to go down. So unfortunately, that wasn't enough breakout on that chart to be able to get the 3 to 1 risk to reward ratio. So having a look at the numbers, there are a couple of options you can do. You can tweak the numbers or try to make them slightly more in your favor by perhaps pushing the take profit out more. So that having a look at the chart, if they think it's going to 0.7440, you might want to trade for this for a bit longer and take it up all the way, maybe up to 0.7460. And you could also drop down the entry a bit, putting it closer to the pivot, so that something like maybe 73.80 or even all the way down to the pivot point, so that if it does execute and open, hopefully your exposure will be compared to the reward will be in that 3 to 1 risk reward ratio. But before you do that, what you do is, because this chart only shows movement for the next half day or day at the most, you'd actually go to the shorter term chart, which shows movement for a couple of days before you decided to tweak those numbers. And as you can see, it wouldn't be worth doing it in this case because the market is going to come up and then it's expected that it's going to come back down. Now, if this shorter term chart showed longer term movement up towards the resistance levels, then it might be worth tweaking those numbers if you were still getting a 3 to 1 risk to reward ratio. Okay, but in this case, because even though there is expected to be some upward movement before it drops down to that second support level, it's probably not worth tweaking the numbers, because if you did extend out the take profit, it's not likely to reach those higher levels, and when it drops down, you'll be exposed to the stop loss. So you're more likely than not to lose money on the trade if this chart is correct. And when you actually look at the numbers on the sell order, which would be the hedge order, the numbers are even worse. And that's the idea of normally what you'd do in a case like this. If the numbers were good in this for that initial buy, you'd also enter a hedge as your second trade. So what you're doing is you'd have both a buy in the system and a sell. Now, if you were in this case to look at having a hedge trade on the sell, if these numbers had worked out, essentially the hedge trade is a mirror image of the buy. So for the sell, your entry would be 15 pips below the pivot point, so 73.60 would be where the order would enter. Then you'd set a stop loss that will be 15 pips above that pivot point, because remember, this is a sell, so if it comes back upwards and above the pivot point, then you're losing money. So therefore you'd set your stop loss 15 above the pivot point, so it's 73.90. So again, you're exposed for 30 pips. And then you'd set your take profit, because remember, this second hedge trade is a sell. You'd set your take profit at 5 pips above that, so it's 73.54. But again, as I said before, when you actually look at that second sell order and crunch those numbers in, the risk-reward ratio is even worse. You're risking 200 to only make 50. So so definitely in the case of this trade, you wouldn't want to trade this on the intraday charts. But again, what you can do is if the intraday trade doesn't look appealing or you're not getting that 3-to-1 risk-reward ratio, what you can do is you can go back to the short-term chart and see if a longer-term trade might meet the criteria for that 3-to-1 risk-to-reward ratio. And the basic principle is the same, even though it's trading over a longer period of time. You're going to set up two trades, in this case a sell, in the indication of where the chart where the chart looks like it's going, and also a buy as a hedge. Now, in the case of these longer-term trades, you actually want to push out your entry and stop losses. You want to make it more than 15 pips. The reason for that is because this chart is showing longer-term movement. There's more. There's going to be more movement up and down over time between around the pivot point. The shorter-term chart only shows a short-term movement, so it's more tighter. So because you don't want those stop losses, the trade to execute, but to come back down and hit the stop losses, you want to push them out more to give the market a bit more latitude in its movement, because you're going to expect more because this is over a longer period of time. But the basic technique is the same. So in this case, you'd set a buy order, right? And this would be an entry level order, so it won't execute immediately, only when the numbers are reached. And you'd set this, you'd set as a sell, and you do it instead of 15 pips below. You'd probably look at doing it something like 30 pips below. So it's you do that at something like 76.58, and then you do the 10 pips above that. You do that at for the stop loss. You do that 30 above. So you do that at 76.40. Then you do the take profit. You'd probably come up 10, maybe in this case, not the 5 that you usually do with the take profit on the intraday chart. So you'd probably do that at maybe at 71.60. So again, what you're looking for is you're looking for a 3-to-1 risk to reward ratio. You'd be looking at, in this case, an exposure of 60 pips between the entry and where the stop loss would be, and then where your reward would be down here to say 10 pips above that support level. And what we'll have a look at now is we'll look at the numbers on a couple of other trades, just to be sure that you can understand. So this is for the US dollar Swiss franc. So if you have a look here, the pivot point here is 1.0035. What you'd be doing is you'd be setting an entry rate at 15 pips above, so at 1.0050 would be your entry point for the first buy order. Then you'd set your stop loss at 15 below, so at 1.0020, and then you'd set your take profit at 5 pips below the second resistance at 1.0125. So then you'd set that at that take profit at 1.0120, and as you can see, those are the numbers there. Then for your second hedge trade, what you do is you'd set the entry rate at 15 pips below the pivot at 1.0020. You'd set your stop loss again at 15 pips above the pivot at 1.0050, and then you'd set your take profit at 5 pips above at 0.9950. So again, what you're looking at with these two trades is you've got both the buy and the hedge sell trade are both looking at roughly that 3-to-1 risk to reward ratio. So for example, with the buy here, if it does open, you'd be opening it at 1.0050. Your risk would be that 30 pip bandwidth down to 1.0020, and then your reward would be all the way up there at 1.0120. So hopefully you're looking at that 3-to-1 risk to reward ratio. And again, for the sell, you're looking at a similar 3-to-1 risk to reward ratio. Okay, now obviously some currencies have different decimal points because of the nature of the way that they're traded. So for example, gold is traded out to 2 decimal points. So as you can see here, the pivot there is 1224.5, which is the equivalent of $1,224.50. So with gold or with other commodities that are traded to 2 decimal points, you're looking at a $2 gap. So your entry will be $2 below that pivot, so at 1222.50. Your stop loss again will be above the pivot because this is a sell, so that it would be at 1226.50, and then your take profit will be at $2 above that second line of resistance, so at 12. Okay. Now, for the buy, for the hedge trade, which you open as a buy, you put the market order entry rate will be at 1226.50, so $2 above the pivot. The stop loss again is going to be $2 below that pivot, so at 1222.50, and then your take profit will be at 1232.50. So again, you're looking at that 3-to-1 risk to reward ratio. Okay, and then we'll do one more just to make sure that you've got the hang of it. In this case, this is the US dollar, the Japanese yen. So according to this is a sell, right? According to Trading Central, the dollar yen is going to pivot around the 114.05 mark, or $114.05, and they're expecting that it is going to go down towards the second support level here of 113.10. So what you do is you're going to again set two dormant market entry orders. The first one that you're going to do is going to be a sell, and you're going to do that 15 pips below the pivot. So that would be the entry order at which you would execute and start trading if there was enough movement away from the pivot, is going to be at $113.90. Your stop loss in this case would be 15 pips above the pivot, so that you're looking at, that would be at 114.20. So again, you're exposed for 30 pips above, centered on that pivot, and then your take profit would be 113.15, or 5 pips above that second resistance level. And then you'd also do the hedging buy order, which would be would be again an entry level order that would sit there until it was executed, and the entry rate at which that would start trading and become executed upon would be 114.20. So that would be 15 pips above the pivot. Okay, your stop loss again is going to be 15 pips below the pivot at 114.90, and then your take profit is going to be up here at that second resistance level at 114.65, 5 pips below. And the basic idea of this is that look, sometimes there are a number of scenarios that could play out with an order like this. It could be that the market, there's not much movement, which means that the market is moving closely around the pivot point, which means that neither the buy order or the sell order will be executed, because there won't be enough movement away from the pivot for it to be activated and start trading. So that means that you'll neither win nor lose on a trade like this if the movement is fairly tight. In some cases, in a worst case scenario, what can happen is that actually there's enough movement for it to come down, execute the sell order, right, but not enough momentum to hit that take profit, comes back up, hits the stop loss, so you've lost money on that trade, then comes back up, but there again, there's not enough movement for it to hit the take profit on the buy order, and comes back down and hits the stop loss. So in that case, you would have lost money on both the buy and the sell. But that's fairly rare, because that would have to be a lot of volatility in the market for that to occur. Other scenarios could be that it might be that the market's moving and it comes up before you have a bullish market that comes up, executes the first hits the entry level order for the buy, doesn't have enough momentum to come up because the general trend is down, so drops back down and hits the stop loss. So you've lost money on that first buy, but there is enough momentum for that to continue all the way down to hit that second support level. In that case, that sell order would have activated when it hit the entry level order up here, and then you would have made money down to here. And because you're exposed on that first buy was only a 3-to-1 risk to reward ratio compared to what you're making on the sell, then you're going to come out ahead, because again, you're using risk management techniques, so that even though you had both a loss and a win, the loss was contained by the strict stop losses, and the profit was larger, because again, it's gone all the way down to that second support level as expected. And look, and in some cases, a happy day, what can actually happen is that there's enough movement in the market for it to come up, open on the buy, go all the way up and to hit the take profit on that entry level buy order, and then come back down and hit the second and hit the sell order. And then enough movement to come all the way down and hit the second take profit. So in some cases you might actually get a double take profit if there's enough movement in that case, and that's obviously what you're hoping. So what that means is that by using strict stop losses and take profits, and by using 3-to-1 risk to reward ratio and risk management, you're going to be more likely to get to stack the odds in your favor as you get that movement. Okay, and the second part of this strategy is that you want to trade across a multiple, across various currencies and also commodities as well. You get on the daily technical charts that you get each day. These are the commodities and currencies that you want to trade across. You want to trade across the Aussie US dollar because you know the Aussie is seen as a commodity currency, so any movement in commodity prices will affect it, and it's also traded as a proxy for China, which is the world's second largest economy. So that is quite a volatile currency, and you can expect lots of movement, which is what you want. You also want to trade the Euro USD, you know, because obviously the Eurozone is huge, from mighty Germany to tiny Greece, so there's lots of economic news coming out of there, political elections, economic statistics that are coming out by European governments, things like that. So again, you're expecting lots of movement and volatility, which is what you want. The British pound USD, again, the pound is highly traded. With Brexit and Britain charting its own way out of the euro, there's a lot of opportunity in economic news, both good and bad, that will be coming from that. You also want to make sure that you're trading these two Japanese yen pairs. The reason for that is that oftentimes these currencies will move against each other because the yen is seen as a safe haven. So if there are bad economic news, say out of the US, that's affecting the US dollar or the pound, a lot of traders will park their trades into the yen, which is seeing it as a safe haven, which means that they often these trades move against each other. So again, you're looking at more volatility, and you also want to look at gold and oil because those two commodities have a lot of volatility as well. So you're always looking and expecting lots of movement. And also, you want to hedge further by also looking at doing an indice such as the Australian Stock Exchange. So that way, by spreading out your trades across a variety of different currencies and commodities and also indices, you're more likely to get movement, because it might be in some cases that market conditions might be flat for one currency pair, but it's unlikely for that to be the case with all of these. And if there's some unexpected events such as a terrorist attack or unexpected news or a shock election result, then that's only going to affect one currency pair or two. So that way you're again mitigating the risk by trading across a variety of different currencies that move across each other. So there are. So this is just a quick reminder of what we just covered before. Always try to make your trades first based on the intraday technicals that analyze projected movement for today. You can tell that because of the time period in the upper left, and because it shows movement only over a week time frame. If you're having trouble doing some of these calculations, extract the numbers out. So if you're having trouble taking away 15 pips from 1.34, think of the number as 1.3400, and it makes it much easier to calculate. All right. Always remember that the entry rate or the level at which the order starts trading should be above the pivot on a buy and below the pivot point on the sell. The stop loss should be below the pivot point on a buy and above the pivot point on the sell, and the take profit should be above the pivot point on a buy and below the pivot point on a sell. Okay, and above all, always make sure that the risk-reward ratio is in your favor before you place your trades. It should be at least 2-to-1 in your favor, but you should ideally it should be 3-to-1, and you have to be very careful at the start when you're actually looking at tweaking the numbers. And so once the orders have been entered, they'll be moved to the entry orders folders, waiting for the entry rate to be reached. Once that entry rate is reached, it will trade, and then the order will be moved to the open positions folder. And then once hopefully that your orders hit the take profit, or unfortunately it's hit the stop loss, it's then moved to the closed positions folder. And finally, just be very careful about doing this trade if you don't have much equity in your account. Because you'll be trading across a broad variety of currencies and you can expect movement in them, you want to have enough equity in your account to make sure that you've got a safety margin before before making these trades. But again, you want to trade across as many of those currency pairs as you can and commodities and indices, because again, it's another form of hedging. So that's basically the way this system works. By using tight stop losses and take profits and risk management, you're putting the odds in your favor by trying to get that 3-to-1 risk reward favor, and also by trading across a variety of different trades, for commodities, currencies, and indices. Again, you're mitigating the risk, because it could be that one currency pair might go haywire for some reason, for some unexpected news. But again, by trading across all of them, you're much more likely that you're going to get some of that movement in which you've got that 3-to-1 risk-reward ratio in your favor. So look, if you've got any questions or anything, then please get in touch with us and ask. Look, good luck with your trades. Thank you very much.